Okay, good morning, folks, and welcome to Members Stock Chart Request. This is where we review the symbols that our members submit for me to review. We changed up the week ahead commentary, which I sent out yesterday, and rather than focusing in on stocks that we're looking to trade for the coming week, I wanted to focus on preservation of capital. And how do we do that? We do that by reaching out to members, asking what symbols that they are currently holding or watching, and we manage our risk in this very, very volatile time, which is soon to get more volatile. So to succeed in this business, it's not about trying to catch a falling knife. It's about, again, preservation of capital. You can't piss in the tall straw with the big dogs without your capital reserves. So that's what today is all about. But before we do that, I want to talk about the proximate cause of this sell-off. And oddly enough, the proximate cause of this sell-off is actually the reason why it occurred to begin with. What you're looking at here is a chart of U.S. government borrowing. And you could see that at current, we are taking out highs not seen since 2012. So this new administration is spending a dramatic amount of money. Now, that's okay. It all depends upon what you do with it, right? If you're investing for the future, that's great. But in the short term, it's not accretive to GDP. Perhaps in the longer term, it may be. Now, before you get bleary-eyed and say, you know what, I got to go watch another video, let me explain it to you a little bit better. This chart here is a chart of the 10-year yield. And you can see that for the most part through 2016 through to September of 2017, not too long ago, folks, we were in a clear and defined downtrend. All of that changed in mid-September. And that's when the conversation with regard to tax cuts began to get more airtime and play in Congress. Fast forward to when it became a real reality in Congress in mid-October. Well, you could see that we were in a firm consolidation, and then we began to break out. The euphoria began, the bull run, the blow off top in the markets began. But now the euphoria, since the tax reform bill has passed, has subsided. And now what we're dealing with are the ramifications of increased spending and reduced tax revenue. And that is a dramatic rise and a breakout in interest rates. And I've been saying this for quite some time. Every market bubble or cycle top over the past 20, 25 years has been caused by interest rates moving higher. And if I were to be asked, is the Federal Reserve going to act promptly in trying to manage these interest rates? I mean, after all, they been announcing that they're going to have 3, perhaps even 4 now rate increases in 2018. No, I don't think so. I think they're going to act pretty slowly, unless, of course, we get some serious drops like we got last week in the stock market. Because remember, in Washington, the stock market is the economy. It's the barometer by which they are measured in terms of success. So before we get into the charts, and you're wondering, why are we in the position that we are, meaning we just had a beautiful, euphoric rally in the stock market ever since late September, early October. The stock market could do no wrong. It was in anticipation of tax cuts. The problem is that nobody on CNBC, Bloomberg, or on Fox News were talking about the ramifications, and that was the breakout in interest rates. It's for real. It's here, and it has to be dealt with. And the markets are now beginning to wake up. But historically speaking, the Federal Reserve is usually asleep at the wheel, and then they are forced to act. Let's get to the charts. All right, so again, these charts are submitted to me by members. They're either A, positions that they're holding. We're going to work on identifying good stop points. Where do I think that these stocks are going? And we're going to do so from a top-down view. What does that mean? It means that we're going to view the performance of every single chart here, and I have quite a number of them, from a weekly view, that's the higher level view, perhaps even a monthly view in a couple of cases on the real volatile stocks or ETFs. Then we drill down to a daily chart. Now, before we begin, folks, the charts that I've gone over, and I've gone over a tremendous amount of them for members and a number of other charts just for my own education on where I believe that this market is heading in the short term. I do believe that we are headed lower, absent intervention. And that intervention could come by the EU. You have Mario Draghi scheduled to speak this week. But most importantly, it's going to be out of the U.S. Federal Reserve. And we have a number of Fed governors scheduled to speak this coming week. Now, you may be saying that, you know what, Bob, I own some really top-tier stocks. Earnings per share growth, outstanding. Sales growth, outstanding. Price to earnings ratio, reasonable. There's no way this thing is going to go down. Folks, everything will go down. Why? It's because we are at all-time records with margin debt. Why does that impact your favorite stock? No matter what the fundamentals, it's because when you have forced liquidation of positions, they don't care what you're holding. You need to meet your margin requirements. And unfortunately, most people tend to sell their winners rather than their losers to raise capital. So don't get lured into a value trap. They may be quicker to recover. I wouldn't argue that point. But in the short term, everything is going to get clubbed, much as they did on Friday. Now, members, throughout the remainder of the week, we are going to be doing market wraps discussing our strategy and how we plan on tweaking it each and every day this coming week. But the 2 bullet points I want to put up that should be paramount to everybody is A, stay small, B, manage your risk. And I'm going to be talking about managing risk right now. Now, let's kick things off with UPRO. This is a leveraged ETF for the S&P 500. For all intents and purposes, it's as if you're looking at the S&P 500, the SPY. All right, so on a weekly basis, we were down 11.39%. On the week, we have no support below until we get down to 140 on UPRO on a weekly basis. Now, staying small and managing risk may not sound sexy for those who are new to trading. But if this is your first correction, you'll learn to appreciate that managing risk and staying small is the key to taking advantage of some really great bargains as they begin to appear, because there is going to be a ton of money made in the coming months, whether it be to the short side or to the long side in quality stocks. Have no doubt about it. The key, however, is living to play another day. Absent your capital reserves, you can't take advantage of the opportunities that are going to present themselves. So no doubt about it, a ton of money to be made here. But first, we need to firm up our portfolios and build our cash position. Let's get to our first stock chart request, which is UPRO, which is for all intents and purposes the spiders, but this is a leveraged ETF weekly chart. Let's get to it. We were down 11.39% on the week. We are looking at support here on a weekly basis, down at 139.63. That's where I think we're going. Might we have a rally before we hit that level? Absolutely. But I think it will be lower highs. I don't think we're going to be breaking out anytime soon. I think we're going to be retesting support levels. And that goes for the S&P 500 as well, obviously. Daily chart. Now, on a daily basis, you could see that we topped out at 172.46. What appeared to be some support was not. It was just cut through like a hot knife through butter. They tried to recapture it. 3 consecutive days, failed, breakdown on Friday. So again, I don't think that we have really good support until we get down to this level here, last seen back in December. So I think that any rallies absent a recapture of a support level are to be sold. Volume on Friday was extremely high. Watch your Stokes. They're poised to go below 50 probably on Monday. So my call on UPRO is avoid, lighten up. I am at current bearish on the S&P 500. the SPXS, which puts you short of the S&P 500. All right, so let's begin with a weekly chart here. We were long of the SPXS going into this sell-off. We are now out of it. What are we looking for? I wouldn't be the least bit surprised if we get some support out of the Federal Reserve, a brief rally on the S&P 500. I do believe that rally is to be sold. I'll be looking for a pullback on the SPXS to a retest of this breakout point here in dotted blue line. On that retest, we could look to buy the SPXS. What if we don't get that? What's the game plan? We could do one of two things, or both. Either A, buy on a new weekly breakout, or B, buy on a close above this primary upper band of resistance. If we close the week out above this primary upper band of resistance, this market is in a lot of trouble. Volume last week, probably the highest on record for this short ETF. Daily chart, we have a breakout on RSI, a breakout on Stokes, a beautiful breakout on price. We're going to have a little bit of resistance up here at, let's call it 2750. Volume outstanding. Where do you stop out? I think if we break down below Thursday's lows, you would need to reconsider your position. If we break down below 2422, you really need to be out of that position. ITA, the iShares Aerospace and Defense ETF weekly chart. This sector got overbought. We broke out above the upper band of the rising uptrend channel. We're now pulling back to retest. If we break back down into this trading range, we're coming down to retest this lower band of support here at, let's call it 190, 191. Volume, very strong last week. Daily chart. On a daily basis, you can see we have resistance at 206.04. If you short this, you need to put a stop right above that level. We did close down below this lower band of the rising uptrend channel. And the market sent you signals. And this chart looks very much like Amazon, which I'm looking to short right now. These candlesticks, like right here, that's a doji star formation. Here you have a hollow-filled candlestick. Here you have a failed rally at resistance. And so sellers move in, taking it off the highs of the day on Thursday. Friday, club like a baby seal. We closed down below key support, and we did so on volume. Choppy action on Stoch RSI, lower highs and ultimate oscillator, lower highs on RSI, and a confirmation breakdown on both RSI and Stokes. You need to avoid these shares. Now, does that mean that they can't try to rally back to recapture the support level? Sure. I would look to short into that strength. The next chart up is the SGG, the Bloomberg Sugar Index. This is a monthly chart. It's very volatile. It's a commodity. So therefore, we want to use a very quiet chart, not a noisy chart like a weekly or daily chart, but a quiet chart. It filters out all the noise. So what we're looking at here is a very, very bullish setup. I have been getting more and more bullish on agriculture commodities over the past several weeks. And this is a perfect case in point. While I don't think that this is a core position right now, I think that it should be looked at as a speculative trade. We have a double bottom setup on RSI and a higher low from the prior low. No breakout yet. We have a W formation forming, or a double bottom setup, whatever you want to call it, on your Stokes. No breakout yet. A close above this point here, last seen back in October, that's a buy signal. Now, on price, a beautiful, classic W formation, a multi-year setup. I think that this could be bought with a stop right below 24.16. I would stay small and look to buy on strength, particularly on a close above 33.23. But the SGG is looking really good from a macro view, daily chart. Now on a daily basis, a lot going on here, right? A lot of noise. This is why we use the monthly chart to get that higher level view. We've been in the consolidation since June of last year. The upper band of resistance is at, let's call it 33. The lower band is at, let's call it 26. So as a trade, I think that this can be bought on close above 27.72 and expect a rally up to, let's call it 31, because we're putting in lower highs here. Let's call it 31 in anticipation of a lower high. But once we clear $32 per share and we close there on a daily basis, brother, that means that we've overcome all of this resistance, all of this overhead supply, and now we're going to move higher, probably up to $36 per share. So SGG, one of my rare charts that I'm going over this week, which I am bullish on. The DGAZ monthly chart. This puts you short of nat gas. The first thing I'm going to point out here is that on a macro view, and if I just said monthly chart, it's a weekly chart. I'm not sure if I was accurate. So on a higher level view, we have a head and shoulders setup which has formed. Left shoulder, head, right shoulder. Here's your neckline. Now we bounced off of that neckline last week and we flashed a bullish key reversal. It was a devastating week for natural gas, but it was overbought. Would I be a buyer of the DGAZ right now? No. Why? We need a breakout above this upper band of resistance and a close there. We have been in a severe sell-off for several weeks now, and frankly, it was unsustainable, especially when you have support below, which emboldened the shorts to move in, and here you have your bullish key reversal on the week. Volume was outstanding. This was institutional accumulation. So I'm not willing to say, given the volume and the players involved here, that we're not heading higher. I'm just saying that I wouldn't buy it yet, not at resistance on a weekly basis, daily chart. Now, on a daily basis, I think that we just saw a massive short squeeze. Why am I saying a short squeeze? Take a look at your volume. While it was very strong at the beginning of the week, it really died off on Friday. Would I be a buyer here? No. Where would I look to buy if I was bullish on DGAZ and I wanted to speculate? One of two areas, either A, a pullback and a retest of this support level here at 22.23, or a breakout above this upper band of resistance and a close above $25 per share. Where would I stop out? If I were long right now, honestly, given the topping tails and the hollow filled candlestick and the fact that we have resistance above, if you make a new daily low, you're probably going to come down to this support level here at, again, 22.23. If you close down below there, you should probably be out. Because remember, the long-term trend is still down on the DGAZ. So let's not ignore that the probabilities still favor bears, despite the fact that we had a strong week last week. Best Buy. Retail, we had gone over this with members. Retail reached a high on RSI of about 92 on a daily basis. So it was only a matter of time before Best Buy, Costco, which we were looking to buy, would roll over. And Best Buy finally did. Now, I went very bullish on Best Buy. It was one of our picks back here in October, November. And then we broke out and it was off to the races. So a great trade, but I think that trade is over for a while. In all probability, we're pulling back down to $65 per share. And if that breaks, we can come all the way back down here to retest this support level between, let's call it $57.50 and $53 per share. Daily chart. So on a daily basis, RSI rolling over with lower highs and lower lows. Stokes, same deal. We have both lines on Stokes trading down below 50. And as I always teach members, when you have both lines on Stokes trading down below 50, do not go chasing rallies. Why? It's because rallies fade, much as this one did right here on Thursday. If you bought in the morning during that rally, you got sucker punched by Friday. Don't let this be you. Manage your risk and stay small. The next chart up, PepsiCo, PEP. We're putting in lower highs on RSI weekly basis, which is a divergence, meaning we broke out to new all-time highs, yet RSI never validated it. And we are putting in lower highs. Now, we haven't broken down to new lower lows yet, but we're close. Obviously, very bearish action, a bearish key reversal last week on volume. Daily chart. Now, on a daily chart, we were in a bull flag formation. We broke down and closed below the lower band of support on Friday. If this selling continues, expect support at 116.50. You have some support where we bounced off of on Friday. But I think if the rest of the market continues lower, PepsiCo will follow suit. Volume on Friday was very light. I will say that. So while I'm not as bearish on PepsiCo, I don't think it's a buy right now. And it's a watch. If we make a new weekly low, I would avoid it like the plague and watch for it to hit support at 116.38. The next chart up is KMT, Kennametal Inc. Weekly chart. So we have a breakout point failure here. We broke out the week of January the 2nd. We have since rolled over and given up those gains. So when we have breakout point failures or bull traps, the probability of us retesting the lower band of support down here at 42.50 is very high. So that's my price target. So if we make a new weekly low, in all probability, that's where we're going. Volume rising sequentially. So now we have institutional distribution. Daily chart. Much like we saw in PepsiCo, we were in a bull flag formation. That has now failed. We're trading down below the 50-day moving average. I will say this, though. We are below the 3 standard deviation Bollinger Band. It's not going to stay there. More than likely, in the next couple of days, if this continues, we'll get a trade sideways with a bias to the upside, perhaps in an attempt to try to recapture this lower band of support. Then it will probably roll over again. Volume, very high on Friday. Don't fight these guys. This is not mom and pop selling 100 shares. These are institutions. RSI really weak. Lower highs, lower lows. Same deal on Stokes. I would avoid these shares. And again, going back to the weekly chart, this is our defense line here, 42.26. If that fails, we're going down into the 30s in a heartbeat. So watch the volume. Watch how well we defend these support levels. The next chart up is Alibaba. Alibaba broke out 2 weeks ago, right here, out of this pennant formation. Last week, a bearish reversal week, no new high. Lower highs on both RSI and Stokes. Very, very choppy action here on your Stoke RSI with volume. That was extremely high. MACD, head fake. It appears as though we're going to fail here to break out on the MACD. Now, on the bullish side, we have not broken down below this key support level. We did not put in a new weekly low last week. So let's go to the daily chart. Now, unlike the rest of the market, Alibaba did not get as overbought. But as I said in the beginning, even the best stocks are going to take it on the chin during the sell-off because margin debt is so high. Traders will sell anything because they don't have the cash to put into their brokerage accounts to cover their margin calls. So everybody's going to suffer here. So we broke out on the 24th, and this is where price action really matters. We had a decent couple of days continuation breakout. Then all went bad here on the 29th. Inside day, no new high, no new low on a closing basis. A down day on the 29th. A failed breakout with topping action on the 31st. And then clubbed on the 1st and 2nd. And we closed back down below key support, which is now resistance once again. So we're going to retest the 185 level. If that fails, we're going down into the 170s. The next really serious support level on Alibaba, I would say, is at between 166 and 167, in that ballpark. If that fails, we're coming all the way down here to 147.50, which marked the August lows. Volume is very high, so we're seeing institutional distribution. So in terms of price performance, this is one of the least worst, but still, I wouldn't go buying right now. Now, Amazon is looking extremely toppy here. Weekly chart, we have resistance at 1,500 or 1498, which is the high. And you can see that we had a ton of profit taking up there. taking the shares off the highs of the week. Now, volume was very high, but a lot of that was selling. Daily chart. Now, RSI was at about 89.90. We've certainly backed down off of that level. Now, Amazon is a stock that I'm looking to short. Why? It's because my risk reward is pretty good. I know exactly where to put my stop, which is right above recent highs. We have shorted Amazon before. We did so back here with very similar price action. We had a hollow-filled candlestick, much as what we do right now. That's a sign of indecision at the top of a trading range. Never, ever good for longs. Now, you may be saying, Bob, it closed up last week. It outperformed the market. Why do you want to short it? It was up because you had an earnings report. Absent the headline news, would there have been an up day here? I would argue not. So, members, more to come here on Amazon. The next chart up, CSGP weekly chart. A bearish reversal week last week. This is a sign of topping. The prior week we had topping action on top of this candlestick. That implies that we had sellers moving in, setting the stage for last week's downward move. We were also leaning into the third standard deviation Bollinger Band. We did so for 2 consecutive weeks. That only lasts so long. In short, what does that mean when you lean into your third standard deviation Bollinger Band in red? It's not supposed to be there. Expect a pause, expect a pullback. It doesn't necessarily mean go dumping your shares, but in the short term, it's overbought. Relative to its 20-period moving average. So we haven't broken support here. I wouldn't go shorting the stock. I would consider shorting it on a new weekly low with a price target of 314.73. Daily chart. We're in a bull flag formation. So as far as I'm concerned, we're in a consolidation. The overall trend, back to the weekly chart, is to the upside. Are we seeing some weakness here? Absolutely. Would I be shocked to see a breakout? Not really. So the jury is out. So what's the game plan where I long of the shares? I would use a stop right below the 340 level. If we take that out, in all probability, especially if we close there, the shares are going a lot lower. So 340 per share would be my stop point. Depending upon your risk tolerances and your personal financial situation, you may want to keep it tighter or looser. It's your call, but that's my call. The next chart up is CoreSite Realty Corp. This is a classic case of when markets send you signals. We put in a high on RSI back in June, right back here. The shares were trading at a high of 110.70. We began to move to new highs, but RSI, making lower highs, diverged. So during, I should say, the week of November the 27th, we put in a lower high on price. That's when you really got to take your crayon out and draw your support levels. Because if we break, as we did this week here on the 8th, you should have been out. But you got lucky because they tried to rally it back to recapture support, which they did, but it failed to hold it the following week, being last week. I would be a seller of these shares. Daily chart. Now, on a daily basis, we have a big rounding top. We made multiple attempts to put in higher highs, failed. But we managed to put in a series of higher lows. So that kept a lot of traders in, right? That all ended here. January the 10th, we began to smash through support levels. Fast forward to last week, we broke down below key support. They'll probably try to rally it back up to 106. I think that the shares will probably roll over and head lower. I would not be a buyer of this stock. And if you're looking for a stop loss point, if we break down and close below 102.27, I would really consider stopping out of the trade. And that's it, folks. Members, tomorrow morning I'll probably put together a morning update. We'll review the futures market and our strategy. I will be in the forum in the members area later on this evening and this afternoon. So if you want to discuss these symbols, please let me know, or any other symbols. Post a topic and I will certainly get back to you. Everybody have a profitable trading week. And remember, today's lows can be tomorrow's highs. So please be careful in this market. Stay small and manage your risk. Have a profitable trading week.